With the income statement complete, we now turn to forecasting the balance sheet line items. So as you recall in the last video, we completed the income statement forecast to reflect the management guidance. There's several line items on the income statement that have yet to be forecast, namely interest income and interest expense. In addition, we're going to forecast depreciation amortization down the road when we look at property, plant, and equipment and intangible assets. But right now we turn to working capital balance sheet items. So down below here, we've got the sort of the placeholders for those working capital line items. Notice I've also labeled them EOP for end of period, and I've opened up my balance sheet to the right here so we can look at some of these line items. I've aggregated most of these working capital line items together. I've sort of put together the line items that have the same forecasting driver. That way I don't need to necessarily have an individual line item for every line item here if the drivers are always going to be the same. And so let's take a look at what I mean by that. Let's start with accounts receivable. So this company doesn't just have one line called accounts receivable, they actually have three. The first line is called trade accounts receivable, which is what we normally think of when we think of accounts receivable, which is BMC extending terms to its customers. And the terms are basically you have 30 days to pay. Then you have something called trade finance receivables, which is we're going to help you finance the thing that you're buying from us, and you're going to pay us an interest on that. So that's a little bit different from accounts receivable. It's finance receivables, but really in terms of drivers, you can think of it as being driven off of the same thing. The more revenue that we expect to see down the road, the more of these finance receivables we expect to generate, just like we expect to generate more accounts receivable. Notice that this actually has a second component, which is a long-term trade finance receivables. If you're extending terms beyond 1 year, that's going to get bifurcated into a current and a non-current account. Again, for our purposes in terms of forecasting, it's going to be driven off of revenue, so we're just going to lump it all together. So why don't we go ahead and do that first? So we're going to identify these three line items in here. All right. So we're going to do 2013, and then you're going to do 2012 on your own. So let's just kind of calculate this as a percentage of sales, because that's going to be our driver going forward. And so this represents 20% of the company's sales. And so going forward, let me just kind of maximize the screen here. Going forward, we can do something like this where we say, you know, going forward, you're going to have the accounts receivable equal 20% of sales, just like it's been historically. You actually have a couple of choices in terms of how you do this driver, and then you sort of back into revenue or back into accounts receivable by multiplying by the revenue forecast. And so if I expect my AR to revenue ratio to stay the same, then this is what I would expect my AR to look like going forward. This is probably the most common way to forecast accounts receivable, as those of you who've gone through our financial statement modeling course know quite well. A couple of bells and whistles you could add to this. For example, you could add a bell and whistle here, which says if, for example, you don't really want to have a thesis here, you don't want to put anything in here, you can add an if statement here that basically says if there's something in here, then use this formula. But if there's nothing in there, then just grow revenue, or then just grow accounts receivable by what it was last year by the revenue growth rate. Now let's just pause and take a look at that for a second. Let's close that parentheses. So now what Excel is doing is it's saying, hey, there's nothing in this cell, so I'm going to regress to a standard relationship, which is accounts receivable growing at the rate that revenue is expected to grow, which should make logical sense, right? The more revenue that I expect to generate, the more my receivables should grow in equal amounts, assuming that there's no change in ratio of sort of cash sales versus credit sales for this company. Now, interestingly, if I actually have a forecast in here, it doesn't change anything because my forecast uses the prior year's relationship, and so it regresses to the same growth rate. But if I did something, so let me actually open up that balance sheet again, and let me show you one other thing that could happen here. So if I have, for example, if I do the same thing for the prior year, so I'm actually going to do this one with you guys. and I do that, and I calculate the ratio to revenue now, and now I create an average of the last several years relationship instead of just the last prior year. This is another common way to forecast accounts receivable and a lot of working capital items. Notice now that the numbers change. This is an implicit thesis. I'm basically saying that I think the ratio of AR to sales is not going to be exactly like it was last year, but rather it'll be an average over the last several years. Both are totally acceptable in terms of what's considered a standard forecast, but they both lead to slightly different results. And then so what that means is you have this third feature with this if statement that says, if you don't want to use some average relationship, or you don't want to explicitly say anything, you don't have to have anything in here in the first place. This if statement makes it so that we can just kind of grow the relationship naturally without you needing to explicitly say anything. So a couple of things. We're going to format this blue to indicate that this is not, although it's not necessarily a physical hard input, it is a decision that we're making to make it an average. I actually want to make it just like this, just to be consistent with the completed model. And I'm going to copy and paste this across. So just a couple of bells and whistles in terms of how you forecast by adding these if statements, meaning you don't have to have a driver in here.